High interest rates have boosted BDC dividend yields into the double digits. This is the time for business development companies to shine, but there are about 50 of them, and who has time to pick the best ones? What we need is a BDC fund. After researching BDCs, I've invested in 8 of them, and so far I've made videos about 5 of them. I like the high income, historically about 8%, but the current high interest rate environment has pushed that up to more like 10%. If you're not familiar with BDCs, they act like a hybrid between private equity, venture capital, and a bank. And their tax status requires them to pay out 90% of their income to shareholders, similar to REITs. Whereas banks lend out customer deposits, BDCs lend out funds they either borrowed or raised by selling shares. For a more detailed explanation of BDCs, check out this review of one of my favorites, Capital Southwest. Some BDCs are winners and then some are clunkers, much like regular stocks. Of the 50 or so out there, I've probably missed a few of the good ones. It's frankly a little bit overwhelming. So I'd be happy to pay a fund manager a bit less than 1% to figure this all out. Today, we'll look at the most popular BDC fund and whether it's worth considering, and we'll also look at a new BDC fund that I think might be better. A quick disclaimer, I'm not a financial advisor. Since retiring in 2017, I began researching my investments in far greater depth because, well, they pay for everything now. When I find something interesting, I make a video. BIZD is the most popular BDC fund with over $500 million under management. Looking at recent performance versus the market, and it's not hard to see why. Over the past 3 years, BIZD has produced a total return of 71.5%, more than double the S&P 500. If we compare on price alone, they're about even at 26%. The rest of the 71.5% return came from dividends. This looks great, but a lot of it is timing. If we zoom out to 5 years, BIZD falls behind the S&P 500. The inflection point was the pandemic. The market panicked in 2020, fearing a wave of defaults. BDCs sold off, the Fed printed money, and the defaults just didn't happen. So if you bought during that panic period, the returns were outstanding. But that's an anomaly, and if we zoom out to 10 years, we can see that the market outperformed BIZD by a wider margin. BIZD is currently yielding a juicy 10.89%, and the dividend history is fairly consistent over its 10-year life. Even though BIZD doesn't always beat the market, the income looks attractive, so should we just buy it instead of trying to pick individual BDCs? Well, to answer that, we need to know how BIZD works, and it's really simple. VanEck BDC Income ETF, ticker symbol BIZD or BIZD, for those outside the US, is just an index fund. It tracks an index called the MBIS US Business Development Companies Index. The BIZD holdings and allocations just mirror what's in that index. Looking at the largest components of the index, I noticed 2 things. First of all, the market cap weighting skews the allocation heavily towards the larger BDCs like Ares Capital. Secondly, the list contains some familiar names. I've reviewed these 4 and Capital Southwest, which is a bit further down the list. Managing a fund that follows an index sounds pretty easy. Every quarter when the index is rebalanced, you just copy and paste the changes into the fund. So fees for a passive fund like this should be low. Don't freak out. It's 10.92%. Passive fund fees are usually less than 1%, so that sounds, well, ridiculous. There is an explanation. BDC funds are required by the SEC to publish an expense percentage that includes expenses that have nothing to do with managing the fund. For example, payroll expenses from the individual business development companies within the fund have to be included. I'll include a detailed explanation in the description, but what you really need to know is that the actual management fee for BIZD is just 0.41%. Apart from the yield, here's what I like about BIZD. If you like the idea of BDCs, but don't want to spend time picking them, BIZD will give you exposure to the sector with one click in your brokerage account. The index formula favors large cap BDCs, and that doesn't directly lead to better performance, but larger BDCs do have some advantages. They tend to have a more diversified loan portfolio, which reduces their exposure to any one borrower. They also tend to have better access to debt at cheaper rates. Before we move on to the limitations of BIZD, a lot of my research for this video came from seeking alpha, not just the charts, but also the in-depth articles. I read these 5, and I often include a link to my favorite article, but this time I'll suggest 2 and include links to those, because this article makes a good case for BIZD, and this article makes a good case against BIZD. I've covered some of the major points, but these guys go into way more detail than I can in this video. Since 2017, I haven't purchased a stock or a fund without first researching it on Seeking Alpha. If you haven't tried it, there's a link in the description for a free trial. If we compare BIZD to some of my favorite BDCs, it lags behind, as shown in these 5-year and 10-year total return charts. That's not because I'm some kind of brilliant stock picker. It's more that BIZD just has its limitations. It mirrors an index that selects for one criteria, size, and it concentrates heavily based on that one criteria. The top 3 holdings alone are approaching 50% of the portfolio, so you better like those 3 companies. Most importantly, it ignores the metrics you might use to choose a BDC, like growth in net asset value, price to NAV ratio, dividend coverage, percentage allocation to the less risky senior loans, that kind of thing. BIZD is the biggest BDC fund, but not the only one. There's also BDCZ or Z from UBS. It tracks the same index as BIZD, but has somehow managed to underperform BIZD. And that's puzzling and frankly enough to just ditch it. But there's also one other problem with that fund. It's not an ETF, it's an ETN, an exchange-traded note. When you invest in an ETF, you're pooling assets with other investors, and those assets are separate from the assets of the fund manager. With an ETN, you're buying a bond that's backed only by UBS and not the underlying assets. But it gets worse. The disclosures for the note clarify that it's only backed by a UBS subsidiary, not the UBS parent company. There are other situations where ETN risk can be mitigated by diversing into a basket of notes, but this is one note backed by one subsidiary. I think it's an unnecessary risk. Then there's BDCX, also from UBS. Same thing, but with 50% leverage sprinkled on top. It's only been around since 2020, so it's only seen good times. The leverage has enabled it to outperform BIZD over that short period, but you could guess what would happen with that leverage during a market decline. And just like BDCZ, it's an ETN, not an ETF, so it's not for me. So far, I'd say BIZD is okay if you want BDC exposure and you're not too fussed about optimal returns. But why can't someone just create a BDC fund that buys the best BDCs, then adjust the holdings based on current value and risk? In other words, an actively managed BDC fund. On September 20, 2022, Putnam did exactly that. The Putnam BDC Income ETF, ticker symbol PBDC, is what I've been looking for, at least in its design. Instead of tracking an index, the fund manager, Michael Petro, selects BDCs and rebalances the holding as he sees fit. It's too early to assess Michael's skills at managing PBDC, but he's off to a good start in the first year, pulling ahead of BIZD by 4 points since inception. But we need to see how the fund does during a correction to get a clearer picture. Let's take a look under the hood of PBDC before we wrap up. You probably won't find an accurate yield anywhere yet because they're calculated on trailing 12-month dividends and it's less than 12 months old. PBDC has issued just 3 dividends. I usually ignore the first dividend after inception because it's not exactly 1 quarter long. The second dividend was 72.85 cents and the third dividend was slightly higher at 75.61 cents. That makes sense because BDCs have been raising their dividends this year. If we assume no further raises for the next 12 months, being a little bit conservative, and multiply that 75.61 cents by 4, we get $3.02 divided by the current price of $30.57, gives us an estimated yield of 9.9%. Not bad. If we look at the top holdings, I've invested in and reviewed 4 of them. I've also invested in Blue Owl Capital, but haven't made a video about it yet. So at first glance, the holdings look pretty good to me. The expense ratio is 0.75%, higher than BIZD, but I'm not surprised because this fund is so new and so small. 0.75% times the assets under management of just $38 million equals $285,000. And that's not going to cover Michael's salary, overhead, and marketing. Meanwhile, BIZD fund manager VanEck has $658 million in their fund at a 0.41% fee. They're generating $2.7 million of revenue, more than enough to keep the lights on and hold the Christmas party somewhere nicer than the break room. The small size of the fund means that daily trading volume is less than 10,000 according to the Putnam website. Meanwhile, BIZD daily volume is in the hundreds of thousands. That low volume means that if you place a market order, it'll probably get executed at an unfavorable price. So you have to use limit orders to get the market price, and that can take a while to execute. If PBDC continues outperforming BIZD and increasing its liquidity, I'm very much open to shifting some of my individual BDC capital over to that fund. Michael, if you're watching, consider this an informal invitation to come on here and tell us your plans to kick BIZD's butt. I think you're set up to outperform them. You just need to spread the word, and the armchair income community can help you with that. After surveying the BDC fund landscape, my current plan is to continue investing in individual BDCs as part of my income portfolio. But I like researching BDCs, and frankly, most people don't. So if you want some exposure to the sector, BIZD is okay, and PBDC has enormous potential, liquidity notwithstanding. Before I go, I mostly make videos about investments I like, but I like some more than others. So if you want to find videos of my favorites, I made a playlist to save you time. That wraps it up for this look at BDC funds. More armchair income coming soon.